Hi, everyone, and welcome to the January 2019 edition of our U.S. Executive Podcast. I'm Greg Dacko, Chief U.S. Economist at Oxford Economics, and I'm joined today by Lydia Bassour, Senior U.S. Economist.
Hi, Greg. So the government shutdown is now behind us. What do you think the implications were and for the economy?
Well, it was the longest government shutdown on record. We had 36 days of government shutdown, and that really represented, in our view, a triple threat to the U.S. economy. The first is, of course, the direct threat from reduced work within the federal government. We know that about 350 government workers were put on furlough, and that's reduced output in terms of GDP growth, and that's actually a permanent loss. That output will never be made up. That being said, we expect some of the lost remuneration to be paid back to federal workers, and that should allow people to spend again. But there is that permanent direct loss that the CBO quantifies to be about $3 billion in terms of the economy. There is also an indirect effect because of the lost income from a lot of these workers during those 35 days. You're going to see reduced spending in the first quarter. Now, some of that will be made back with the back pay, but we still believe that there's going to be some lingering effects. And then you can't forget that there was a big threat of lack of funding for some low-income programs, including the food stamps, which would have had a disproportionately large effect on the economy. So combined, these effects, I think, will reduce growth in the first quarter by 2 to 3 tenths. Not anything major, but still quite significant from a growth perspective. And then the third aspect that we can't forget is that during the past month, we really haven't had much data on the U.S. economy at a critical point in time, a time when global growth is slowing, a time when financial markets are particularly susceptible to any type of new information. So this was quite a scary moment in terms of the U.S. economy. Now, some people have said that this shutdown will have a major effect on the labor market. What are our estimates in terms of the payrolls estimate at the end of this week for January and the unemployment rate?
So we actually think that the impact of the government shutdown on January payrolls will be minimal. So according to the BLS, federal workers that were furloughed during the shutdown, so if they were either not working or working without pay, will be counted as employed in the establishment survey. Now for the household survey, the story is a bit different. Furloughed workers who were not working during the reference week will be classified as unemployed. So there is the risk of a slight and temporary bump up in the unemployment rate. We think it might tick up to 4% in January from 3.9% in December. But just in general, we stick to our view that the strong pace of job creation we have seen in 2018 is somewhat unsustainable, and we think that we will see a slight downshift in jobs growth, a gradual downshift in job growth in 2019. So we're looking for a payroll gain of 154,000 jobs in January, which is still respectable. We have seen some pretty strong high-frequency labor market indicators in recent weeks, and jobless claims, which actually fell last week to their lowest level in half a century. If the jobs report surprises on the downside, there is the potential for a sharp negative market reaction, especially because we have had a high degree of political uncertainty, and there is a lack of timely economic data. This outcome would probably bring back recession talks. So Greg, what do you think about the next recession? When will it hit the U.S. economy?
Yeah, well, the truth is that we don't really know, but you're right that if we get a weak jobs number in this period where we haven't really had much data on the economy, it might spur renewed talks of a recession. We still think the odds are fairly low. In 2019, we put the odds around 25%, but we note that there's a significant slowdown coming for the U.S. economy, with growth going from 3% currently to about 2% by the end of the year, and actually falling below 2% in 2020, around 1.7 perhaps in 2020. So we're seeing that marked deceleration because of the policy headwinds, less fiscal stimulus, more monetary policy tightening, and trade uncertainty, which is still a big question with the talks this week taking place between Vice Premier He from China and the U.S. administration. So we'll see what comes out of that. But we don't expect to see a recession in 2019, just a gradual slowdown in growth. And one important factor, I think, is that we've had a buffer from reduced oil prices. What do you think is the effect of this environment of lower oil prices for the U.S. economy? Is it still a net positive, given that we produce so much?
The steep drop in oil prices that we've seen in the fourth quarter of 2018 has two major implications for the economy. Higher consumer spending thanks to lower prices at the pump and lower business investment through reduced extraction activity. Mm-hmm. But on net, we do think that lower oil prices will be a small boost to the economy this year of about 0.1 percentage point. Now, if we look at the consumers, the 33 cents average decline in gasoline prices in 2019 that we are expecting will represent a 45 billion annualized saving, or 0.2 percentage point of GDP. Now, of course, the boost to consumer spending will depend on consumers actually spending their gas windfall instead of saving it. But we think they will, and they actually have already starting to do so. Gasoline prices started declining right ahead of the holiday season, so the timing was quite good, and that was confirmed by strong retail sales in both October and November. Now, on the negative side, given that there is usually a 1 quarter lag between changes in oil prices and changes in oil and gas business investment, the hit to capex will pose a drag on GDP in the first quarter, and this drag is likely to peak in the second quarter. Because WTI oil prices have already rebounded above, the $50 break-even level for shale producers, the drag should be modest and short-lived. So, Greg, that rebound in oil prices, it's actually part of a broader improvement in financial markets at the start of 2019. U.S. equities have already rebounded more than 10%. We have now the government shutdown behind us. What are the implications for the Fed? Are we still expecting a pause?
Yeah, I think we're expecting the triple P from the Fed at the upcoming January FOMC meeting later this week. The reason that we're expecting that triple P is because we still feel like conditions don't necessarily warrant the Fed continuing to gradually or further gradually raise interest rates. The three Ps are a pause in rate hikes, patience, and prudence when it comes to guiding monetary policy. We know that the lack of data is going to affect the Fed's decision, and Chair Powell has indicated a desire to be a little bit more cautious and attentive to market development. So in the current environment, despite the fact that markets have seen a rebound, and equities in particular have seen a significant rebound, we still expect that the Fed will be cautious when it comes to the start of the year. They don't have much more visibility than we do in terms of what happened in January. They don't have the data. For a data-dependent Fed, this will likely warrant more caution. So looking ahead, we still continue to expect 2 rate hikes this year, no rate hikes in 2020, but I think the Fed will be very cautious when it comes to raising rates, and it will probably not raise interest rates in March. The late April, early May meeting is a possibility, but increasingly I feel like the next rate hike might actually not come before June. So we'll see what happens in terms of Fed policy. Again, still 2 rate hikes baked into the forecast. With growth slowing, the Fed is going to be very careful as it attempts to maneuver a soft landing, something that is very difficult to do when an economy is slowing, as we know from previous experience. So with that, thank you very much, Lydia, and we'll speak again next month.
Thank you, Greg.